I'm Ernie Humphrey, Educational Programs Leader for Proformative, the largest online community for corporate finance, accounting, treasury, and related professionals. I'd like to welcome everyone to today's webinar, Building a Formal Business Case, an Expert Perspective on Financial Software ROI. The adoption of cloud financial system continues to grow across companies of all sizes and across many industries. Companies that are still considering this transformation are asking themselves the same critical question that's applied to every strategic business decision. What's the ROI? A solid business case that's rooted in a clear ROI and demonstrable payback not only unlocks budget dollars, it provides a roadmap for successful deployment and maximum value. Today we'll hear from Rebecca Wettemann, Vice President of Nucleus Research, and Vijay Ramakrishnan of Intacct Corp, and they will discuss how to formally define the value proposition of a cloud-based financial application for your company and share the keys to developing a compelling justification based on metrics that assess both direct and indirect benefits. I would like to thank Intacct, whose commitment to thought leadership helps us make this webinar possible and delivered at no cost. A quick note on today's agenda. First, we'll hear a joint presentation from our featured speakers, and then we'll move to an interactive Q&A session where we'll spend the remainder of our hour. We'd like this to be an interactive experience for you. So if you have any questions at any time, please go to the questions area in your GoToWebinar control panel and send us your questions. We can't promise to get all of them in, but we'll do our best, and we'll follow up afterwards with any questions we did not get to. A few logistical notes about the webinar. A link to today's presentation and video recording of the webinar will be sent out to all attendees within 24 hours of the event. Please note the presentation is already posted at Proformative.com. Those who would like CPE credits will need to answer all the polling questions during the event and should have pre-registered for CPE credit. For any questions on CPE credits, please send an email to cpe@Proformative.com. Again, we encourage you to ask questions on today's topics via the questions area box in your GoToWebinar control panel at any time during the webinar. Finally, you'll be asked to take a short survey regarding today's webinar, and we greatly appreciate your feedback regarding our event today, as we always strive to improve the ROI we offer our event attendees for their valuable time. A quick word about Proformative. Proformative is the largest online community resource for senior-level corporate finance, accounting, treasury, and related leaders. Proformative connects corporate finance leaders to provide instant advice and insights on the tough financial and strategic challenges they face every day. Okay, let's get started by introducing today's speaker, Vijay Ramakrishnan, Director of Product Marketing, Intacct. Vijay is Intacct's Director of Product Marketing, where he helps organizations understand how they can use the cloud to streamline financial management processes and gain new insights to drive business strategies. Prior to Intacct, Vijay was at Talio, where he helped HR leaders use workforce data to make the organization more effective. Through his 15 years of experience in the software industry, Vijay has always been focused on how organizations can capture and analyze the right data to optimize performance. With that, it is my distinct pleasure to hand the floor over to Vijay Ramakrishnan and Intacct. Vijay, please take it away for us.
Thank you, Ernie. It's great to be here today with Rebecca and share with you some knowledge that Rebecca and I have around building the business case for financial applications in the cloud. And so getting on to, just a brief roadmap of what you can expect today, I'm going to spend a little bit of time speaking with you about how cloud financial applications are creating process impacts throughout the mission. And I'll do that fairly briefly. I'll spend no more than 10 minutes on that. And then what Rebecca is going to walk you through is how you take in those impacts created by technology and quantify them. Quantify them to build a business case, and she's going to take you through some detailed steps, some things to watch out for, some best practices around that, and really looking at technology impacts and building a business case around that. And so the bulk of today's presentation is going to be Rebecca sharing her knowledge and the knowledge that Nucleus Research has developed around building the business case. And then at the end, we'll take some questions and point you to some additional resources. So that's the roadmap for today. Let me start by addressing a few things. And one is Intacct. I work for Intacct, and we're a provider, fastest growing provider of cloud financial applications. And I wanted to share with you a couple of reasons behind why financial managers love cloud financial applications like those from Intacct. And what you're going to see is that the reasons that these applications are gaining such tremendous traction are because of the impacts that they create that translate directly into quantifiable ROI. So there's really two ways in which applications like Intacct work and impact the lives of financial managers and impact the lives and processes of finance departments. One way is that these applications make you better every day. They take your core business processes, your core financial and accounting processes, and through better automation, through better oversight and controls, through better accuracy, they just simply make you more efficient. There's less headcount resource, there's less time that's spent around these core processes. But there's a second impact, and the second impact has to do with all of the strategic things that you can do now that you are spending less time on the tactical things. And when you can spend less time on the tactical things, not only does that translate into a very quantifiable ROI, it creates the time and space for you as members of a finance organization to think strategically and to begin to think about driving performance and growth for your organizations through the better visibility and flexibility that cloud financial applications provide. So on the efficiency side, if you look at the core processes that you in the finance organization need to manage, whether that's within finance and more of an accounting process, or whether it's a business process that cuts across, sales, services, and finance, things like order to cash, procure to pay, time and expense management. There's a lot of data moving through these processes. And a lot of times these data, the data that cuts across the different parts of these processes might be stored in multiple systems. Some of that information might even be in paper-based forms. And so as an organization, in addition to having the data in multiple places, you might be dealing with new standards and rules around these processes that you're trying to implement. There may be a lot of spreadsheets involved with these processes. And because of the manual nature, because of the spreadsheet-oriented nature, it's very difficult to enforce oversight and controls. So you take a lot of time checking, double-checking, triple-checking things. And so the message is when you don't have a lot of automation around these core processes, there's the scope for inefficiency that comes from wasted resource and people having to spend too much time on doing things manually. And so with a cloud financial application, what you do is you get the benefit of automation that makes you more efficient. The ability to automate all your financial processes, the ability to automate how data moves from your financial system of record back and forth with other systems that are critical to the functioning of the business processes in your organizations. The ability to manage those processes in a fairly dynamic way too. So if you have certain ways of executing on a process within your organization, cloud financial applications like Intacct can mold to what you need from a business process perspective and ultimately collect all important process data in one place through automation. And so if you look at just the automation benefits that you can get from cloud financial applications, there's very clear ROI that you can get through this automation route. And again, Rebecca is going to walk you through how you could quantify some of that ROI. Now that's, as I said, half the piece of the puzzle. So once you gain hard ROI through this kind of process-saving impact, what it sets you up to do is spend your organization's time focusing on the bigger questions that drive longer-term growth, that drive longer-term value. So for a lot of times for our customers, in addition to automating processes, they're looking to answer bigger questions that will shape the future of their organizations in terms of understanding the products and channels that are driving revenues and profits, in terms of understanding the structure of their costs so they can figure out how best they're going to be able to grow, what kinds of resources they're going to need in order to be able to grow. Now, in order to answer those questions, what you really need is all of your data collected in one place. And by automating those processes, that's the benefit, the first benefit that you get in terms of data is you have the data collected in one place. They're not in multiple systems anymore. All of that process automation that's resulted in those hard savings has created a single set of data that you can begin to look at to answer the bigger questions. And not only do you have all the data in one place, with a best-in-class cloud financial system like Intacct, you even have the power to understand that data by various business drivers. So this is where you can really begin to understand the why behind why your performance is the way that it is, and how you can shape and monitor that performance on an ongoing basis. So those are some of the ways in which cloud financial applications create some very direct impacts through process automation and efficiency, and set you up to make some longer-term decisions that create value and that create impact in the longer term as well. And so because of those benefits, what these cloud financial applications can do is, as they've done for our customers, help support you through various stages of that you have, whether you are just stepping into your first true integrated accounting system, or whether you are a company that has longer-term ambitions or very near-term plans to go public and beyond as you support other strategies and look at other strategies for growth. And so cloud financial applications are getting a tremendous amount of adoption thanks to the ROI that they can drive, thanks to the growth that they can fuel. Just wanted to share with you just a quick snapshot of the range of industries that Intacct's cloud financial applications are impacting, and they can do that, again, because of the ROI that they're driving. So with that, what I wanted to do was hand the floor back over to Ernie, who's going to help us with the first polling question.
Okay, thank you very much, Vijay, for your great content and your insights. We've gone ahead and launched our first of 3 polling questions. As a reminder, those of you after CPE credits for today's webinar will need to answer all 3 polling questions during the webinar. Of course, we appreciate everyone's consideration in answering our polling question. Time permitting, we may review the results of the polling questions and get comments from our speakers during the Q&A session. Again, we encourage everyone to please ask questions on today's topic via the questions area in your GoToWebinar control panel. I'm going to leave the polling question up for another 30 seconds or so, and I'm going to introduce our next speaker, Rebecca Wettemann, as we wind down the time allocated for our first polling question so we can make sure to maximize the value of the time of our great speakers today. So our next speaker is going to be Rebecca Wettemann, Vice President, Nucleus Research. Rebecca is responsible for directing and managing Nucleus's industry-leading quantitative research team. She has written and presented extensively on the subject of enterprise applications, CRM, collaboration, and integration technology, and its impact on business. She's an expert on the financial analysis of technology and is the author of numerous return on investment studies and reports. Prior to joining Nucleus, Rebecca directed IDC's European Collaborative Technologies programs. Ms. Wettemann holds a BS in Political Science and a BA in French from Oklahoma State University and a Master's of Law and Diplomacy degree from the Fletcher School at Tufts University. With that, it is my distinct pleasure to hand the floor over to Rebecca Wettemann of Nucleus Research. Rebecca, please go ahead and take it away for us. Thank you.
Thank you, Ernie, and thanks everyone for joining today. Delighted to be here to share with you some of the research and insights that we've developed in looking at the evolution of cloud financial applications over the past decade or so. So what I wanted to talk about today in the time that we have together is some ideas about how to identify the ROI potentials from applications, understanding those key financial metrics, how to evaluate project costs, but more specifically, evaluating direct and indirect benefits, and really hopefully give you a framework that you can take away from thinking about delivering a business case within your own organization. But before we go there, I'd like for you all to just think for a minute about what you think the ideal return on investment from a financial management application is. Is it 23% return on investment? 223%? For those of you high rollers out there, is it more like 5,223%? Or are you really looking for those big gains? Well, I share these numbers with you today because a 35,000% ROI is likely going to be ridiculous to most of us. But the important thing to remember about building a business case for a cloud financial application is that it's not about building the most accurate or detailed return on investment, but having a structured understanding of what you're going to spend and what you're going to get from the technology. Now, at Nucleus Research, we've been working for a little over 13 years in helping companies build a business case for technology. We've published more than 450 case studies looking at specific technology deployments, and we work with customers on an ongoing basis to help them evaluate the potential ROI, not just to justify a purchase, but to use that business case as a roadmap for ensuring they get the most value over time. We have looked at organizations large and small deploying cloud financial systems and found key benefits in areas such as increased productivity, increased visibility, reduced or avoided IT costs, improved inventory management, accelerated financial processes, and reduced audit costs. Now that all sounds like a great list of benefits. But to build a business case, what we find is that the strongest business cases only have 2 or 3 benefits. So as we think about how to focus our efforts on a business case, there are really 3 steps to follow. First, identify those top areas of real benefit. Second, gather and validate the cost and benefit data. And third, assess those all-important financial metrics. So as we talk about ROI, the first step is really identifying those key areas of benefit. In working with clients over the years, Nucleus has found that there are really 2 core factors that drive value from a technology project: breadth and repeatability. There are 3 subsidiary factors: risk, collaboration, and knowledge. Let me share with you just a few thoughts on each of those areas. Breadth, one of the most important factors. A technology project that impacts a greater number of people is likely to have a greater return on investment. Now, breadth and repeatability really go hand in hand. The greater the repeatability of the application, the more often it will be used by the more people, the higher the potential return. And what we find is, if you look at those key benefits and how they might apply to your own organization, rating them in terms of breadth and repeatability are likely to tell you where you're going to get the most bang for your buck, where you should focus any pilot or initial deployment efforts, and really the greatest benefit areas for return that you want to focus on in your business case. The other 3 factors become important, particularly when it comes to financial management applications. Are you replacing a risky task? For a lot of customers we look at, reducing audit risk is a key motivation for going with a more sophisticated, modern financial application. The 4th factor is collaboration. And when I talk about in detail some of the case studies that we've looked at, we find that, believe it or not, the collaboration component is a key piece for many companies going to a cloud financial application. Having employees access the application anywhere at any time and be on the same page is an important collaboration component to driving greater innovation and growth from a cloud financial management application. The 5th factor is knowledge. Will a project involve the management of key information? Well, the obvious benefit for financial data here is clear. But what we find, in short, is that if you look first at breadth and repeatability, then at risk, collaboration, and knowledge, you can quickly identify those benefits that are likely to deliver the most return on investment, where you'll want to focus your efforts both on the business case and on the deployment itself. So that's really the first step, identifying the top areas of benefit that you want to focus on. Before we jump into assessing costs and benefits, I want to quickly run through the key metrics that Nucleus recommends companies look at when assessing any technology project. Return on investment, of course, being the key one, we calculated based on 3 years, simply because that's a reasonable time horizon given technology projects today. Return on investment is an important metric because it's the best overall measure of how technology impacts that bottom line. It looks at all possible costs and benefits, both direct and indirect, and simply it can be easily compared to the cost of capital or another investment. The challenge with return on investment is it only measures your own internal performance. And trust in ROI is often limited by some of the lack of industry standards and some tricks that vendors sometimes play in manipulating ROI. The other challenge with return on investment is it really looks long-term over time, which is why we recommend that customers also look very closely at payback period. This is the break-even point, the time needed before the net savings equals the initial cost. It's an important measure of risk and a key measurement that you should look at. Very good for risk assessment because it really tells you when you'll have that money back and can afford to reinvest it again. This is particularly important in an area like cloud financial applications, where the technology is evolving so rapidly. You want to understand, can you invest today, and with the next upgrade, enhancement, or alternative, do you have your cash back to be able to reinvest? The other key metrics that customers look at is total cost of ownership. Obviously, total cost of ownership is part of the overall financial equation. We warn customers, however, not to just look at TCO because it looks at cost and ignores benefits. While it's good for budgeting and comparing similar applications, it doesn't take advantage of the top line. It doesn't measure those performance benefits. It doesn't measure those key areas that we're looking for, which is really getting the most out of technology over time. So those are the key metrics that we look at in helping customers to calculate their overall business case. I want to spend a few minutes talking about the key cost areas to think about as you may build your own business case for cloud financial applications. A couple of important things to remember. There are 6 cost categories to look at: software, hardware, personnel, consulting, training, and other. Other is that catch-all, which we've seen for customers can often mean participation in conferences or other sessions, travel, and other costs associated with supporting the project team as they deploy. It's important to remember as well that costs are both one-time and recurring. So we help customers build a framework for calculating both the one-time and recurring costs over that 3-year ROI horizon. Now let's get to assessing the benefits. When we talk to customers about benefits, we first say we need to identify what are the direct and the indirect benefits. You can think of the direct benefits as something that directly affects a line item today, whether it's a reduced cost or avoided cost. Those are the key direct benefits. The indirect side are sometimes called soft benefits: increased productivity, improved performance, improved quality. All of those kind of things that we know intrinsically deliver value to the business, but often are more of a challenge to measure and to project if we're building a business case for the first time. In fact, we've worked with more detail with customers to lay out benefits from first, second, third, and fourth order benefits. First order benefits are those benefits that you know are a direct saving, a reduction in costs. You know it is going to happen. With cloud financial applications, this often means the elimination of IT costs or avoidance of IT costs that would be required without a new deployment. Second order benefits are really those semi-direct savings. You can think of these as direct savings with a hedging word. We expect to reduce costs. We hope to eliminate staff, or we hope to avoid additional audit fees. You've got yourself a second order benefit. Third order benefits are really increases in productivity. I'm going to talk in more detail about how we handle third order benefits, but it's important to remember with third order benefits that you're working with human beings. So in terms of believability from a business case perspective, there's likely to be more variability. One user that's very proficient with a cloud application may have a much greater increase in productivity than one that's less technology savvy. Finally, the fourth order benefits are very indirect savings. These are the ones you really want to be careful about in your business case. When we work with customers, we often say if there are 3 ands in your benefit statement, you have a fourth order benefit. If I improve management training so management's more effective, and that makes employees better employees, and that means they work more productively, and that means the company is more profitable, you can see we have a lot of moving parts in that overall benefit equation. So you want to be more cautious there. And when I say more cautious, I mean as you move out this believability curve of benefits, you want to think more carefully about how are you projecting that benefit? What evidence do you have to support it? And how much of a likely variance there is in what you project versus what you can actually achieve. So as we move out the believability curve, you'll want to think about how you gather evidence and data, and that can be just as important as identifying the benefits themselves. So as we think about different kinds of techniques for measuring benefits, what we find is that direct observation, surveying users, or a pilot site can be great, strong evidence to support a business case. Independent case studies where you can look at customers like you and see what benefits they achieve are strong as well. As you start to look at benchmark data from questionable sources, if you're making guesses or those vendor-supplied estimates that are often more marketing, frankly, than based on real customer evidence, you'll want to be more careful. Just as you move out the believability curve, as you move down the evidence curve, you'll want to think about doing a worst-case assessment to understand exactly the variability that you have in each of your benefits. So let's go back to measuring indirect benefits for a moment, because it's really an important technique. One of the things we spend a lot of time on with clients, and an important way to think about those indirect benefits like productivity, like growth, like the ability to do more with less that are so important with cloud financial applications. We've worked with a number of clients over the years that will say they don't count indirect benefits at all, or they have to have someone specifically responsible for that number. Part of that is because benefits have been overstated over time, but also because companies haven't taken into account the fact that there are real human factors involved in productivity-based or indirect benefits. When we work with clients to build a business case for a technology, when we're looking at things like productivity, which we found contribute on average to 50% of the overall benefits from business cases, we look at the inefficient transfer of time. Folks, this is a technical term for people goof off. Time saved is not directly equal to additional time worked. So when you think about things like productivity, when you're looking at a business case, you want to use correction factors to adjust those estimates to understand what the time saved is versus a reasonable estimate of what the actual value is to a company. Now, why is this important? If we start off with a percentage savings, what we find is that the initial estimate is a guess, that it's discounted over time and ends up being a very meaningless number, and a number that's not helpful in actually milestoning, planning, or measuring success against a projected business case. If we use correction factors, we allow everyone to agree on what the expected time savings to be, and then the discounted the benefit back to the organization itself. This helps us understand how to put milestones in place to understand how much time savings users are actually going to experience, be able to measure against it, but also have a realistic view of what that value is likely to be. So let's talk through a couple of examples of case audits we've published on financial management applications. The first one I want to talk about is Renal Ventures. This is a case study that we published looking at an organization that provides physicians with dialysis services across the Midwestern United States. Now, for this organization, it was working in QuickBooks, which meant a lot of different versions of data and a lot of different places, and a lot of inefficient data collection. Challenges for Renal Ventures that they recognized were lack of visibility, and really the fact that they didn't have an efficient way to gather, manage, and analyze data meant that they couldn't support their growth goals effectively. For Renal Ventures, that cloud application enabled it to streamline financial accounting, increase reporting visibility, and increase productivity. We calculated a return on investment of 154% and a payback of 1 year based on the Renal Ventures project. For them, it was really key to have a cloud application, given the distributed nature of their business, to make information accessible to all business users and partners, regardless of their physical location. Two key things to remember here. First, there was a productivity benefit, a third-order benefit, based on certain members of the organization, particularly management, that were able to access the application, save time. There, we added the correction factor. But when it came to streamlined accounting and reporting visibility, what we really found was that Renal Ventures was able to do more with fewer resources. They were able to become much more efficient, have much better visibility and reporting while avoiding staff. Avoiding staff for Renal Ventures was a first-order direct benefit. That's certainly a great case of an example where both manager productivity, an indirect benefit, and avoided staff, a direct benefit, were key parts of the overall ROI equation. Another example I want to talk about is Canto, software company. Canto is German-based and also had U.S. subsidiaries, and what they had was a hosted financial application in Germany that was then accessed via Citrix by their employees in the United States. But they found that first, there was a lack of integration between the systems, so there was a lot of manual reconciliation going on. Lack of integration, but simply the high cost of virtualization, given the aging nature of the system, was a real challenge. The lack of visibility and the lack of a single repository for data meant that Canto spent way too much effort focusing on technology and on manual processes rather than being able to really have higher-level visibility into their business and be able to really understand and forecast effectively. For Canto, moving to a cloud-based environment meant being able to first eliminate those virtualization costs, reduce their overall IT management costs by going to a cloud solution, improving data management, and increasing employee productivity. For them, Canto, the return on investment was 91% with a payback period of 8 months. Key points with Canto to remember is certainly centralized data providing a single source of the truth, not just because it's better to have the data all in one place, but because then managers can really focus their time and effort on doing the reporting, doing the forecasting, doing the what-if analysis that enables them to really plan for performance and growth over time. For Canto as well, it was very important to be able to integrate their financial application with their CRM system. We've seen the integration capabilities for cloud applications greatly reduce in complexity and cost over just the past couple of years, which enables companies to be able to have greater streamlined visibility from finance and across the whole quote to cash cycle. So certainly centralized data is a big point, but being able to integrate with those other applications drove additional value for Canto. You should notice as well that Canto's balance of direct and indirect benefits was interesting. Improved data management and increased employee productivity, really indirect benefits. However, the significant cost savings alone was enough for Canto initially to justify the project. One more example that we looked at, a little bit of a unique one, was the Great Books Foundation, a nonprofit organization. Now, as you can imagine, with a nonprofit organization, employees and contributors were often wearing many hats. They had different roles. They also needed to be virtual. They needed to be able to access the information when they could to do business. They were facing an aging proprietary accounting system that, like Renal Ventures, was creating significant costs just keeping up and running. For the foundation, they really needed a solution with limited IT support, one that provided great usability, so those employees that might not access the application every day didn't have to retrain themselves every time they went into the application. For grade books, moving to a cloud financial management application enabled them to automate processes, accelerate collections, reduce inventory carrying costs, and increase visibility. So a good mix of direct and indirect benefits. For them, the return on investment was 152%, with a payback of 8 months. One of the things that we find often with cloud applications is that modern interface and the ability to really configure it to meet the needs of the business very quickly supports scalable growth and succession planning, an area where someone may not be in the application every day. In fact, when we went back last year and looked at all the application audits we had done of cloud and on-premise applications, Nucleus found that cloud applications delivered 1.7 times the return on investment of on-premise applications. This was because of both that low initial cost, both in terms of configuration and being able to deploy the application, but also the ability to change, adapt, expand the application over the time to deliver additional benefits without the cost and disruption associated with a traditional on-premise application. So for the Great Books Foundation, the initial benefit was there, and the initial payback was there in only 8 months, but it also enabled it to think about how we will grow, support our evolving business model moving forward, and ultimately be able to focus with enough data on key areas of the business like changing the way they manage inventory, accelerating collections, and increasing visibility across their entire process. Now, those are just a few examples of some of the organizations that we've looked at. In summary, I'd just like to point out that what we found is that customers using cloud financial applications achieve ROI through both direct and indirect benefits. That 1.7% cloud multiplier is about low initial and ongoing costs, but it's also about flexibility over time. For Renal Ventures, Canto, and Great Books, it was really about enabling employees to access information from any time, from anywhere, to both increase productivity and grow without having to add additional staff. As you think about these potential benefits in your own environment in building the business case, it's important to remember about breadth and repeatability as those key measures for ROI potential. The greater the breadth, the number of people who will use the application, and the greater the repeatability, the frequency with which they'll use it, are great indicators for ROI potential. All of the customer examples I talked about today had a balance of direct and indirect benefits. But what you'll want to remember is as you move out that benefit curve from most direct to most indirect, building a business case will mean gathering more evidence and expecting greater variability from your projected results. As you think about the metrics, remember the shorter the payback, the lower the risk. CFOs like to think of that as WIMP, what's in my pocket. As soon as I have it back, I can afford to reinvest. And in an area like cloud financial applications, where we're seeing new innovations on a quarterly, sometimes less than that basis, you want to focus on payback so that you can gain benefits today and be able to reinvest that capital in other areas of the business. And finally, we found broadly that taking advantage of the cloud model not only creates a shorter payback period and a faster time to value, but really enables organizations with limited IT resources in many cases to drive greater value over time by being able to enhance, change, grow and add to the application, taking advantage of the innovations and the new capabilities that vendors are delivering to maximize value over time. There are a number of free resources that are available to you at the Nucleus Research website, as well as the case studies I've spoken about today, and our standard financial modeling tool, which can be a great stepping stone if you don't have one for building that business case based on the framework that I've laid out here for assessing benefits and costs. And with that, I will thank you very much for your attention and turn it back to Ernie.
Thank you very much, Rebecca, for your great content and insights. I'm going to go ahead and launch our second polling question. Again, those of you after CPE credit for today's webinar need to answer all the polling questions during the webinar. This is our second question. Again, we encourage you to please ask questions on today's topic via the questions box in your GoToWebinar control panel. With that, I'd like to go ahead and kick off the Q&A session. I'd like to direct my first question to Rebecca. Does an ROI calculation include the cost and time of migrating existing financial data in other systems?
So Ernie, absolutely. We would count that in really two categories of costs where we see it most often in these kind of projects. The first would be in personnel, because there's often internal personnel time devoted with mapping, planning, and understanding, as well as managing the migration. We calculate that based on the average fully loaded cost of an employee and the number of hours on the migration. But it's also often, to a certain extent, on the consulting side, where a customer may want to take advantage of a vendor's professional services, expertise, and skills. In some cases, we see companies making a small investment in software tools that can manage that migration, but I would say that's a small part of the overall picture. The key part of cost around data migration would be around personnel and consulting.
Okay, great. Thank you very much, Rebecca. I'd like to direct this next question to Vijay, if possible, for his initial comments. Do you think cloud computing is a realistic alternative for smaller companies? What is it that drives the ROI for smaller companies in the SMB space and even smaller?
Yeah, thanks, Ernie, and thank you for that question from the audience. It is absolutely realistic for smaller companies, and you know, what happens in a smaller company is that you've got people wearing lots of hats, and a lot of times, you know, the finance person is wearing the hat of, you know, supporting a business process, supporting an accounting process, but also supporting the underlying technology behind that process. And so what happens is, you know, in smaller organizations, you have a finance person's time taken up somewhat inefficiently as they wear an IT hat for part of their time and part of their work and part of their job. When you can move to a cloud application and remove that IT burden from that finance person's list of responsibilities, not only do you get the lower indirect costs of an infrastructure that is maintained more efficiently by a cloud application provider, but you also get that person's time freed up to focus on a lot of times what they're really better at, which is supporting the business from a financial perspective.
Okay, great. I kind of have a follow-up question for you, Vijay. As far as kind of the objections that the smaller companies used to have, or their kind of hesitation in adopting a cloud-based application, how have you seen that evolve over the past few years? Has it transformed away from data security, or are there different concerns or myths out there that small companies are kind of getting over or changing what their concerns are at all?
Yeah, no, I think, you know, I think the concerns, you know, have been there to a great degree in the early stages of the cloud adoption. I think for a lot of people, the concerns have been mitigated as they see their peers moving to the cloud and not running into the issues that they feared. But even as the level of overall concern goes down, one of the things that, you know, if you're looking for a cloud solution, you can do in order to kind of better educate yourself is look at what support the vendor is documenting and guaranteeing in terms of things like availability, disaster recovery, the kinds of security and encryption protocols they follow, how they audit their own processes for operating and delivering the applications. Best-in-class financial management providers will document all of that for customers and provide a level of transparency that address those very specific issues that have been concerns in the past historically.
Okay, great. Thank you very much. I'd like to direct our next question to Rebecca. Can you speak to, are there trends in terms of the ROI numbers by industry that you've seen in your studies? There are certain industries where the ROI seems to be higher or the payback time shorter?
Sure, Ernie. I think the important thing to remember is that really an ROI is a measure of the delta from how far you've come. So a company that's moving from a very inefficient system to a very sophisticated and automated one is going to get a greater ROI. It doesn't necessarily mean that they did a better or worse job. Historically, what we've seen with cloud financial applications is that tech companies, in many cases, tend to be the early adopters. However, moving forward, we're seeing the more traditional companies that were maybe a few steps behind in the way they were automating and managing financial processes do better with the ROI because they're making more of an incremental step as opposed to those companies that may have been making continuous improvements over time. So what we see today is companies focusing on payback periods as understanding very key for them, and that's where we see a real difference between industries. More traditional industries, traditional companies tend to have an appetite for a longer payback period than ones in, say, tech and financial services, for example.
Okay, great. Thank you, Rebecca. Rebecca, I've got another question for you, if that's okay. So in terms of measuring the ROI, where would you say are the most common places where companies kind of make a mistake or don't really do a good job in estimating the benefits? And then kind of a side question, can you break that down maybe between direct and indirect benefits? So if someone's trying to have an accurate ROI, what are the key mistakes that they can avoid?
Sure. Well, Ernie, as I talked about, it's really understanding the difference between direct and indirect benefits and understanding what that variability is likely to be. So with the direct benefits, those are numbers that people are pretty confident on. And in a lot of cases, we find with cloud financial applications that companies can just about justify the initial investment based on those direct benefits alone. So on the indirect benefits, where things tend to get, for lack of a better technical term, squishy, that's where customers really want to look at what are other customers like them experiencing? What are the kind of productivity savings that they can expect? I'll give you the answer of mobile devices. That's a really important one, and certainly an important part of accessing cloud financial applications, that ability to access from anywhere. But what we find is a very high level of variability. So, for example, someone who's very attached to their smartphone may expect a 15 to 20% increase in productivity, while a more traditional smartphone user may expect a limited increase in productivity. In that case, companies need to be honest and realistic about understanding which different groups of users may have a different overall productivity impact and plan both their business case and their training and adoption efforts effectively. So with indirect benefits, probably the biggest mistake that companies make is not understanding that it's not just justifying the number in the business case, but using that knowledge, using that structure to then focus on how do we ensure breadth and repeatability, which is all about adoption.
Ernie.
Okay, great. Yeah,
Ernie,
go ahead, Vijay. Go ahead.
Rebecca, I think that's a great answer. I just wanted to add one point from my own observations about customers that have transitioned systems. One of the things that oftentimes people don't take into account is around changing users day to day, right? So what we're doing here is we're bringing technology in to better support a business process. And so what that means is the screens that people are used to, the buttons that people are used to pushing, how those processes work are going to be different. They are going to be better, but they're going to be different. And so one of the things that is important for people to take into account is what is going to be the effort in order to get people comfortable with the new technology. And so it's a small point, but it's an important one, because for long-term success of the application, you really need the users on board and the users feeling like they're getting the most out of this technology. So I'll just add that as kind of one point that might be a little bit of a blind spot.
Okay, great. Vijay, I've got a question for you. Are you seeing any trends in the adoption by industry over the last year or so? I know when the cloud technology originally came out, it seemed to have a very high adoption in the services industry. Are you seeing more adoption in any other industries, such as manufacturing or some other industries you're seeing some good traction on right now?
I think that in general, the knowledge-based industries have been the first to move to the cloud, because those businesses move faster, and as a rule, cloud applications are more agile than on-premises applications. And so those knowledge-based businesses have really had the need and the appetite for that better agility of cloud-based systems. And I think what you're seeing now is that that wave of services and technology-oriented companies that adopted the cloud first, that is now, again, coming as a wave through other industries that are more hard goods oriented.
Okay, great. Thank you very much. Rebecca, I've got a question for you. Vijay, feel free to jump in. I'll direct this to Rebecca first. Can you speak to generally how the overall TCO for a cloud-based solution compares to that of a typical on-premise application?
Sure. So if we break it into initial and ongoing costs, initial costs tend to be lower for a cloud application, both because I'm paying on a subscription basis as opposed to a perpetual license, but also I'm likely spending less on consulting because I'm doing less customization and more configuration on the front end. On an ongoing basis, we find that typically organizations have a lower cost of ownership as well, even though they're paying higher software on an annualized basis. And I know there's been a lot of debate about this in the marketplace, but in looking at case studies over time, what we find is that if you're planning on never changing, growing, upgrading, or adapting your application, your total cost of ownership with an on-premise application will always be lower. If you plan to make changes, update, expand, upgrade your application, 9 times out of 10, your overall TCO, even if we look out to a 5-year time period, is likely to be lower with a cloud application.
Okay, great. I've got another question for you, Rebecca. Are there both hard IT infrastructure headcount and also soft productivity gain savings involved that people need to consider?
Could you repeat just the first part of your question, Ernie?
Oh, sure. Can you speak to, are there some of the hard costs like IT infrastructure headcount and also the soft productivity gain savings that need to be included in the benefit side?
Absolutely. And what we see in a lot of cases with companies moving to cloud financial applications today is they're likely spending something on software, even if it's just $1,000 for QuickBooks support. And they're likely spending IT resources, whether it's internal staff or consultants that are providing support and hosting for the application over time. Those go away in a real direct cost savings when we move to a cloud model. That said, as I said, the productivity piece is a big part of this, and we see those indirect benefits for productivity both for managers, financial employees, finance and accounting, as well as IT that now has to spend less on managing technology and more about delivering more value from the application.
Okay, great. Thank you, Rebecca. Our next question is going to be directed, I believe, to Vijay to make first comments. Someone has a significant number of customizations to their existing solution, so they've got a lot of customization built in, and probably some of that customization is really, they think, driving their strategic advantage. So if someone moves to a cloud-based system, how can they configure or tailor a cloud solution to meet the company's specific needs? How does that work?
Yeah, it's a good question, Ernie. So as a rule, here's what we find for customers that are coming from an on-premises system where they've done a lot of customization and coming to a cloud system that has a completely different architecture. As a rule, cloud applications are gain their flexibility through what we call configuration. So things that used to be supported with scripts that needed to get rewritten with every upgrade, or other kinds of programmatic extensions are now done through cloud applications as more configuration settings. So that's one general thing that I'd offer. The other general thing that I'd offer is that when a lot of people say customization, a lot of times that has to do with very specific reporting that they need and having to build and hand code reports that they need to get at data that in the way that they want to see them. Again, cloud applications offer a lot more flexibility here in the ways they can offer up data for end users to consume, and the ease with which end users themselves can reshape the views of that data. So there's a lot of ways in which customization costs can be lower. The other thing, the final point I'll add on that is that with a cloud architecture and an application like Intacct, what happens is that they're architected through web services and APIs. And a lot of times, we do this at Intacct, and I think it's important to look out for. We guarantee, as we upgrade the system, that the APIs won't change, so that there's not any need to redo a customization. If you do need to go beyond the configuration for whatever reason, and you want to do a customization, you're going to have some confidence that there's not going to be some ongoing cost to maintaining that every time you do an upgrade. So it's a good question. Has a lot of different facets as it applies to costs and ultimately ROI.
Okay, great. Thanks, Vijay. I'm going to go ahead and launch our third and final polling question as we take our final few questions. So Rebecca, I'd like to direct the next question to you. So on making the business case, of course, there's going to be an estimate of the ROI, and then after the fact, there's going to be some calculations on truing up what the actual ROI actually is from the adoption. Can you speak to, just to drive the point home again, 2 or 3 of the top factors that seem to drive the variance between the expected ROI and the actual ROI that companies are receiving?
Sure, Ernie. It's important to remember that whatever ROI you project for your business case will never be the ROI you measure on the back end. We know that because there are just too many exogenous factors that impact. The key ones to think about really are around how much configuration versus customization you're going to do on the front end. So how variable is your time to value and time to deploy likely to be? On the other end, it's really about how far out you are from direct to indirect benefits. The more indirect benefits you have, the more likely you have for variance. Like those mobile smartphone application users that we talked about, you're likely to have a lot more swing in your ROI. That's why we recommend companies, when they look at the business case, do an expected case and then a worst case, where they discount those benefits or cost factors that are likely to have a significant variability. So, for example, in a worst-case scenario, if I expect a 10% increase in productivity for my finance staff, for worst case, I might want to look expected at 10%, worst case at 50% of that. Does it still make sense for me to move forward? That can be a valuable tool both for understanding the variability in the business case, but also on managing toward expectations and toward ultimately maximizing ROI.
Okay, great. Thank you very much, Rebecca. For the sake of time, we're going to go ahead and conclude our Q&A session. As a reminder, you'll be asked to take a short survey once the webinar concludes. We greatly appreciate your feedback. We invite you to please join us at www.fornum.com to ask any additional questions you may have and to continue this conversation with your peers and the experts you've heard from today. A big thank you to Vijay and Rebecca for their time and insights. They are clearly thought leaders in their field and an excellent source on today's topics. Note that in the post-webinar survey, you'll have the opportunity to express your interest in being connected with either or both speakers and/or our sponsor directly with just a few clicks. Again, I'd like to thank our sponsor, Intacct, who made this event possible with their commitment to thought leadership. And finally, I would like to thank the audience for your valuable time. Again, thank you very much, everyone, and make the rest of your day great. We appreciate it. Take care.